Thank you, John, for joining us. Really, really great to hear your perspective on the plight of the economy. Obviously, CEO David Solomon said last week that there is a good chance that we could see a recession. Your economists have said that's closer to about a third of a chance that we'll see a recession. And in your role as president, you're talking with clients all the time. You're talking with the C-suite. What are they telling you about the state of their business, and how does that all kind of come together for your predictions about the potential for a recession?
Well, it's great to be here, Leslie. I appreciate the time. It's good to see you again. I would say most CEOs right now are still of the belief that the U.S. economy is pretty resilient. And while there is some early sign of weakness in elements of the economy, broadly speaking, it's hanging in there pretty well in the U.S. for sure. Less so, obviously, overseas. The things that we're watching are really the forward indicators. You know, you want to watch advertising spend. You want to watch kind of demand rebuild in terms of supply chains are working their way through. We've gotten through a lot of the disruption. Does the supply get reset, you know, back into those chains at the same level as it was working through, or are they working off of kind of, you know, last 6-month demand orders, and the new demand will come in softer? And so I think there are some signs, certainly anecdotally, and some of the clients we talk to, that there's some weakness coming, you know, on the forward. But I think by all accounts, you'd have to say the U.S. economy is still hanging in there pretty well.
Weakness on the forward. As you look ahead, I mean, I think some CEOs have given it about 6 to 9 months before we could see a real downturn. And a lot of that they lay at the feet of inflation, and that ultimately eating into the pocketbooks of the average consumer. Is that something that you see as well?
For sure. I think inflation is the single biggest issue that we all have to tackle right now, which is why you see the central banks, the Fed in particular, being so aggressive in its posture to try to tackle, you know, the inflationary impulse. Definitely companies that we talk to are wrestling with inflation. They're obviously wrestling with commodity input price inflation, but also, I'd say more significantly, wage price pressure.
Which is stickier.
The challenge right now is we have 3.5% unemployment, so you have actually a pretty tight labor market with everybody predicting a recession and demand destruction coming. And so it's very complicated for companies right now to plan for 2023 because they still have a very tight employment picture. While they know their demand, they're forecasting their demand will get weaker. So I think you could preview that there probably be some wage pressure and some margin pressure in corporate America, which should have some negative implication for earnings. And I think a lot of investors today are trying to figure out, where do I price earnings in 2023? How much of a decline do I want to buy into, and what's the right multiple for that, you know, for that earnings stream as it comes down?
But as we saw banks report last week, the consumer remains very strong, very resilient. You agree that ultimately inflation will have an impact here if it's sticky enough, and do you think that will ultimately be the culprit for the recession, or will it be just the rising interest rates and the
I think inflation is
there?
Already having an impact. I think consumers, if they're not spending less, they're substituting. So you're starting to see some change in behavior. We're not yet seeing a real rollover of consumer spend, which I think is what everybody's worried about. My contention would be that one of the issues is there was so much stimulus put in the system that the lag effect of a monetary policy might be a little longer than normal. I'm certainly not an economist, and we talk to our economists all the time about how do you think about that lag effect. But my suspicion would be that we might have a longer lag in the impulse of the policy actually running to the real economy based on how much stimulus was already put in. And so balance sheets are stronger. Personal balance sheets are stronger. Corporate balance sheets are stronger coming into this, you know, downdraft, if you will. And so I think that may have an impact on how the policy actually gets transmitted into the economy.